What's going on, everybody? Welcome back to the channel. In this video today, we're doing a stock analysis on YETI. Now, this was a company requested by Lars. Now, if you want to see a company featured on one of these videos, just write it down here. Comment section below. I read all the comments. I respond to almost all of them. And yeah, I love getting requests to analyze different companies utilizing my very own stock research tool here, and I'll pull that up for you right away. So we're going to look at the fundamentals, the financials, and finally determine a price to pay for this business, and we'll see if it's worth holding in our portfolio. All right, so let's look at YETI. Currently sitting at $48 a share. We've seen a nice little trajectory here dating back to 2019. Now our price has dipped. We were at $108 and now at the high, and now we are, well, currently it's at 48. So interesting, quite a somewhat of a price decrease, a little bit of a price decrease. And I get excited for that because I like when things go on sale, as should you. Now, so let's see if this price makes sense. Rating this company here, we are scoring it a 7 out of 10. Now let's go through those categories and see what makes YETI tick. Now, currently we're awarding it 0 points in the PE category because our average PE ratio is 36.61. However, folks, looking at our company metrics category, our trailing 12 month is currently sitting at 20.15. Now that's great. We want this number to be underneath 22.5. So if that number keeps decreasing, we'll be in that golden range. Now, moving on to our current ratio, we are currently at 1.91. We want this to be over 1.5. Now, that just indicates to us that YETI has enough assets on hand to cover their liabilities. So 1.91, that's a good number to see. So looking pretty good on this end. Return on equity is healthy, sitting at an 83% average. That's actually really good. I thoroughly enjoy that. An average is 5-year. Interesting. Okay, so 83, that's pretty good. EPS growth is up, 144% EPS growth. That's good. Debt to equity is 29%. We want this to be underneath 50%, folks. Now that just indicates to us through their financial leverage that they're growing the business through equity and not taking on debt. Over 50%, things get a little bit shaky, but sitting at the 30% mark, that's actually really healthy. I really enjoy that number. Now, moving on to the second group of categories here, looking somewhat of the same. We have a share dilution slightly being diluted, folks, 0.08%. It's nothing to really worry about. However, we want this number to be staying either the same or ideally decreasing, because when they buy back shares, folks, it helps out the investor, it helps out you and I, because that means that we own more of the business. So this is something to just keep in the back of your head, folks. 0.08, I can live with that. It's not the worst thing. So for some people it is, but I mean, it's so minuscule. Over the 5 years, it's not crazy. Net income, that's growing, it's healthy. However, our free cash flow, I'm not liking this one, folks. This is healthy. This is not healthy. Negative 23.49%. It's been a little bit of a decrease. Let's look at our cash flow statement real quick, and we'll just jump back into that in just a moment. But free cash flow, 80 million. And wow, quite a drop, I gotta say, from 2021 to 2022. $343 million down to 80. Big jumps. I gotta say, huge jumps. 105, 155, 54, 3. Wow, all over the map. And now we're currently at this 80, or rather, well, we're out negative 80. So, I gotta say, I'm not too thrilled about that. Our average free cash flow is 148 million. It makes sense. Had a few 150s in there, as well as it being at 300. That kind of averaged everything out. But we want this number to be increasing, folks. We want this number to be ultimately going up over the last 5 years consistently. This up and down motion that YETI is doing has me somewhat concerned. We don't want to see any kind of rocking back and forth. So we'll keep that in the back of our heads as we progress through this evaluation. Return on invested capital is 34.54%. Now, we want this to be over 10%, and we're triple that number, folks. And if you take a look at the trailing 12 months number, 39.69. It's almost 4 times our amount. So those numbers are healthy. And our 5-year revenue growth has gone up by 13%. It's a very low number. It's just out of curiosity. Look at the income statement here. Now, the revenue's been actually pretty consistent. Look at that. Going back to 2014, you got 147, 468. Now it's doubled. A little bit of a drop there, but 900, 1 billion, 1.4. It's it's plugging away. I wish we had that same consistency with our free cash flow, but I digress, and we don't have that. So, where do I stand with YETI based off this score here? Not bad. Not bad, not great. I'm not going to really dock it points for the share dilution. So for me, it is a 7 out of 10. They are slightly diluting you, but it's not the worst thing. I can live with that. PE ratio, it's not the worst. And considering that it's going down, I can live with this 20.15, assuming. Here's the thing, folks. This free cash flow decreasing, that's the main kicker of this company. Why is their free cash flow decreasing at such and the rocky path that it's had? That's one thing that's kind of throwing me for a loop a little bit. This PE ratio, listen, if they continue their growth, it shouldn't be that high. It shouldn't be 36. You know what? For where I stand right now, it shouldn't be 36. It should be somewhat lower. Under 20 would make a lot more sense, and hopefully it can stick within that number. But the free cash flow, that has to improve and at least be a little bit more in a linear trajectory. But because this rocky business back and forth, not too happy about that. Profit margin is up. I'm just looking at these metrics here as just a cross little comparison. I want to know why. We'll have to dig deep into that free cash flow and see what's going on. Now, we're going to jump into a price analysis. Now, but before we do that, folks, if you're enjoying the video so far, hit the like button, hit the subscribe button. It makes a whole of a lot of a difference. It makes me feel warm and fuzzy inside. It helps me get a good night's sleep. And with that in mind, let's jump into a price analysis to determine what a fair price to pay for YETI would be. So we're going to jump back into here. We're going to fill out all these boxes. We're going to do a 10-year analysis. So let me fill these out, and I'll talk to you and say why I filled them out the way I did. And we'll figure out what to pay for this business. So stand by. Okay, folks. So here's what I did. So if you know me, you've been watching the channel for a little while. If you're not, if you haven't, and you're new here, I like to be conservative as possible. Conservative in a sense where I want to use numbers that I know that they can do. So with a company like YETI, they're making a lot of outdoor gear. They're making a lot of camping gear, coolers, thermoses, jugs, stuff like that. Now, their revenue growth has been crazy over the last little while. Now, they're somewhat of a new business, I believe, when they IPO'd, I think, right? But they are a profitable business. I've seen their gear around. I've seen people carry their stuff around if they go out to picnics and outdoor hikes and stuff like that. Someone's got a YETI. They're known to make solid products. However, the inconsistencies that I'm seeing here with a 29% increase, 13 and 58 really has me begging, what is a consistent number? So this is why I did 10, 11, and 12. Now you're probably thinking, wow, that's lower than what any number that I currently have on this board here. I need to hit these numbers here, folks, because if I hit those numbers and they do better than those numbers, I'm giving myself ample margin of safety. 13% I believe they can hit no problem. But I want to put it at 10, 11, and 12, assuming that the company is going to grow potentially slower. I have no idea this is the problem that I have with this company is that I'll be completely honest with you. Just it's slightly out of my circle of competence. I'm just trying to envision, like, if I was I make outdoor. I'm a tech guy. I like technology. And I'm trying to think of the general public that likes to go hiking and fishing and all these other things. Is that really going to improve over the next few years? as generations start to be more digitized, where things like the metaverse are going to start taking over, where now you have your hikes are now virtual, your adventures are now virtual. The whole generation is growing up with screens, and so I'm really wondering what their core demographic here is. I want to know who do they really pertain to, because I know people that I know that have Yeti products. They usually work in trades and stuff like that. Long story short, what I'm trying to get at here, folks, is I want to be conservative as possible on this revenue growth, because I don't really see this company growing at these large percentage points like they have in the 1 year and 10 year. I can't see that. I can't see that over the 10 years. But you know what? Listen, if you are a Yeti user, call me out on it. I might be wrong, but these are the metrics that I'm using, because I feel like if they can crush these numbers, it'd make this evaluation a lot more better. It gives me that I win either way. That's what I'm trying to say here, folks. They beat these numbers, amazing. They do these numbers and I'm right, phenomenal. Profit margin, we're going to keep this at 8, 8.5, and 9. I think that makes sense because they are in this 5-year category. And if their profit margins are increasing, I believe they can hit 9%. Not a problem at all based off what they've shown us. Free cash flow margin, 7, 8, and 9. Similar game we're playing here. We're playing within these 5-year numbers that we've currently established. And the 1-year number, I'm just going to slightly be within that range as well. Price to free cash flow, going to go 14, 16, and 18 on the high side, as well as our PE ratio for the 10-year outlook. I want to keep 20 on the high side because I think that's, as they're growing this business, I feel like 20 is manageable. 16 after 10 years, that seems like it might be doable just based off the market cap. Actually, I don't know, because it's a 4.25 market cap. There's... This is a company, it's hard. I'm just going based off the numerics here, but because I can't really foresee what numerics we're trying to deal with. So I'm going to go with my desired return of 13%. Now look, we're pulling up $45 average calculation. Green across the board on our average calculation. So Lars, you that requested this company, we're almost at this fair value. If you take a look at it, we're almost at fair value for this company based off what we've shown here. And now this is assuming a fairly low revenue growth on our aggressive category. 12%, with a profit margin of 9, free cash flow of 9, 18 price to free cash flow. That's incredibly low number. And well, considering we have at 53, keeping the same PE ratio at 20. Now on the other side, our conservative amount is 33.41. So that needs to fall down to at least hit these metrics here. Now, where do I think this company lies? I think it's in between a conservative and moderate. This is where I ideally want companies to be. If they line up in this green category, we're laughing. Now, out of curiosity, I'm going to just humor this by putting in 15% revenue growth and 17. Now, I did that because it plays within this 1 year and 10-year number. And now I did that. And guys, it's green across the board, 52 on the conservative side, 77 on the moderate side. So what does that mean? It depends on how you want to look at your margin of safety, folks. Like, and here's the thing. This is the margin of safety that I'm putting in. I'm putting in 10, 11, and 12. Now, granted, this one probably makes sense. This might be a little bit overkill. I'll be completely honest with you. That might be a little bit overkill. But just these are numbers that I personally feel comfortable with. Trading at fair value, if it hovers around this 45 price range, or like if it's lower than 45 and probably in the 40 range, then it's something that, you know, it could probably be on the watch list and might be picked up. However, to be honest, this is a company that I would have to do a lot more research in. I have no idea. I'm only looking at this just from a numbers perspective. I don't hike. I don't go outside. I just stay inside and I make YouTube videos and stock analysis videos for you, the lovely subscribers and viewers of my channel. My thing is this. I gotta talk to people that go hiking, that use their products. Because what do they have? Low balls, wine tump, like, what are low balls? And they operate in a lot of countries: Canada, United States, Australia, New Zealand, Europe, Hong Kong, China, Singapore, okay, Japan, Phnom. Like, they're in a lot of countries. They do a lot of business. It's out of my circle of competence in terms of I don't hike, I don't do any of these things. But just based off what I've looked at from the financial perspectives, it might be in this price range. So if you're someone that's looking to invest in this company and you know that, oh, dude, they'll crush 10, 11, 12% revenue growth. What are you out of your mind? That's way too conservative, and you think and you believe it's going to probably do 15 or 17. Hey, dude, listen, or ma'am, sir, ma'am, this would be a company that would probably be a buy all day. Remember, folks, like always, you have to do your own due diligence. This software here helps me screen companies incredibly quickly. And if you're interested in obtaining this software, it will be an app, and it comes with a lot of cool features. I don't know if I showed you them. Well, like, look, you have your income statements, your cash flow statements, your balance sheets, and all those lovely features, as well as more things are going to be on the way. So it will be an app, so stay tuned, and it will be available for my subscribers. So make sure you hit the subscribe button and the like button. But like anything, folks, you have to do your own due diligence. This app helps me do that in just an instant. With that in mind, what are my final thoughts on YETI? It's a recognizable brand for someone like me who doesn't do these outdoor activities. I've seen their products. I've seen them around on the odd time I'm outside. So look, if as someone who barely goes outside and hikes, and the odd time that I do go on a hike and I see someone carrying a bottle, you know what? They must make decent products if I know what this brand is. However, I don't know what it's going to look like in the future. But from a numerics perspective, under $45 a share price, probably in the 40 range, it might be something worth to pick up. And I'm glad the price is going down. I'm not too sure why that price is going down. But listen, I like a good stock that's on sale. And if you're watching this, Lars, I'm assuming you do as well. So guys, that's the video. Thank you so much for watching. Write down in the comment box a company you want to see evaluated. I'll take a look at it. We'll put it through the software. We'll have a great time. Anyways, that's the video, folks. I'll see you in the next one.